Consequently, we are seeing a gradual recovery in market volume growth. FMCG market volumes grew in mid-single digits, led by urban. Rural market volume, which at one point in time was declining in double digit, has just turned positive in this quarter. Having said that, we need to be cognizant that these growths have come on back of volume decline in the base. If we were to look at market growth on a 2-year CAGR basis, total volume growth is still marginally negative. With softening of inflation, competitive intensity in the market is increasing. Media deployment, which saw a steep reduction during the high inflationary period, has started normalizing and now is almost back to 2019 levels. We are also witnessing resurgence of small and regional players, many of whom had vacated the market during the peak of inflation. Now let me talk about HUL results for the quarter. We delivered a resilient and competitive performance with underlying sales growth of 7% and underlying volume growth of 3%. Talking about our bottom line performance, EBITDA margin at 23.6% improved 40 bps year on year. Profit after tax before exceptional items at rupees 2,500 crores was up 9%. Net profit at 2,472 crores increased 8% year on year. Speaking about our market share performance, our growth was competitive with more than 75% of the business winning market share, both value and volume. On a 2-year basis, we continue to significantly outperform the market. Moving on to performance across our 3 segments, Home Care delivered yet another quarter of robust performance and grew 10% on a very strong base, balanced between volume and value. Beauty and Personal Care delivered a volume-led growth of 4%. Foods and Refreshment grew 5% with near flat underlying volume growth. Margins in all 3 segments remained healthy, with Home Care at 18%, Beauty and Personal Care at 26%, and Foods and Refreshment at 18%. Talking about some of our innovations, Dove Men Plus Care range, Indulekha soap, Knorr Chinese sauces, Brew cold coffee, and a new range of water purifier by Pureit were launched in this quarter. Surf Excel Matic Liquid was relaunched with a superior formulation. Moving on to our margins, as we had indicated, we remained focused on building back our gross margin and stepping up A&P investments behind our brands. In this quarter, our gross margin improved sequentially by 140 bps, and we stepped up A&P investments by 110 bps versus March quarter 23. Speaking about the progress made on some of our key sustainability initiatives, during the quarter, we signed a strategic partnership with JSW Foundation to establish 10 new Suvidha centers in Mumbai. These new centers will benefit 2 lakh people annually, saving 300 million litres of water over a decade, and will run on solar energy. In association with Genpact, we launched Be Seen, an accelerator program to help scale businesses owned by minority and underrepresented groups in India. This program aligns with our ESG goal of increasing procurement from diverse businesses. FICCI has set up a Center for Sustainability and with leadership and partnership with HUL as a founding member. The center aims to accelerate India Inc.'s climate action in line with government's net zero commitments embodied in the Panchamrit framework. Now moving on to outlook. Near-term operating environment continues to be volatile with weather-related risk. We need to be watchful of the progress of monsoon and any impact of El Nino on cropping and rural demand. We expect market volumes to recover gradually due to high levels of cumulative inflation and the fact that consumption habits typically recover with a lag. In this context, we continue to manage our business with agility and take actions to ensure long-term 4G growth that is consistent, competitive, profitable, and responsible. Speaking specifically about outlook for next couple of quarters, price growth will further tail off with lapping of high prices in the base and sequential pricing reduction. If commodities remain where they are, we expect our price growth to be near flat or marginally negative in next couple of quarters. With inflation moderating, the competitive intensity is likely to go up further. We remain focused on providing superior value to our consumers, building back our gross margins, and investing competitively behind our brands. We expect to sustain our volume growth momentum. With this, I complete my prepared remarks, and now we can take some questions.
Right. Thank you, gentlemen, for giving us a detailed brief into what you see going forward. But a two-part question. The first one is for Ritesh. Ritesh, you said that competitive intensity has increased even as the consumer environment is gradually recovering. So, what proportion of your gross margin savings would you have to reinvest in ad spends? And to that extent, what is it that you can guide for in terms of margins going forward? Because volume, if it sustains with flat price growth, you know what the top line trajectory would be. And the second one, I would like Mr. Jawa to answer, and because it's the first time you are speaking to all of us here, in a process-oriented organization like Hindustan Uniliver, what kind of personal aspiration do you have in your era? And linked to that, what are your near, medium, and long-term goals?
So let me pick up gross margin then, I'll hand over to you. So in gross margin, as you know, the peak of inflation in September quarter 22, we had lost almost 600 BPS margin. This was because we saw very high amount of commodity prices and we never priced our products to the peak of inflation. From the 600 BPS of margin dilution with gross margin, in last 3 quarters, we built back 400 BPS, including 140 BPS in this quarter. A large portion of that, 300 BPS has got invested back in A&P. Our A&P, which was more like 7% 3 quarters ago, and this quarter, as we reported results, is roughly 10%. So hence a large portion has gone back into investing. Overall intensity of competition and also media intensity in the market has gone up. Media investments, if I look at both GRP, also the new age media put together, we're almost back to 2019 levels now. And hence, if I look forward, it's a very similar, in our view, the focus will be to keep driving gross margin improvement and investing behind A&P as you see further amount of dial-up on competition intensity.
So what happens to the EBITDA margin?
Yeah. So this is a time where the line of the margin which is most important is gross margin, because we have to generate fuel to ensure that there's enough amount of investment for driving innovation, for driving overall market development, and hence we are at this point in time squarely focused on driving gross margin. And you've seen the amount of substantial margin that we have increased in the last 3 quarters. More work to be done in that space. And as that happens, idea is to ensure that we're able to further dial up A&P investment. Where we are with the margins today, this quarter you've seen we declared 23.6% margin. It's a pretty healthy margin where we are. Hence focus will be to drive competitive volume growth, sustainable volume growth momentum, and keep investing behind A&P fueled by gross margin. That will be the focus for us from a P&L management perspective.
Just a follow-up on that. So the margins that we've currently gotten, would that be something that you would look in that range? EBITDA margin is what I'm talking at, or maybe we could expect a bit lower in that term?
Our margin, as I mentioned, is squarely focused on the line of gross margin this point in time. We want that to go up. And of course, what comes in EBITDA ultimately get driven by amount of money that we need to spend in A&P. So that will be more of an outcome this point in time.
Right. Yeah, thanks a lot. It's a really good question to start with. First of all, I'm very happy to be here and to speak to you, and hope to have more of these conversations. And as my time develops and we have more things to discuss. But let me first start by responding to your question on how I feel about the whole. So first of all, I'm very excited to be back home, and it's been a long time since I worked in the company and in the country, but this is indeed the company and the country of my birth. So I feel very proud and privileged and honored to have this responsibility. So I'm very excited, and I'm very hopeful, very optimistic about the future. There are many reasons why. To start with, I think India is at a really, really important moment in its history. The opportunity, we all know about that, is immense. And the next decade, we've heard that from many people, is going to be the India's decade. So to be here at this point of time, being in charge of the biggest and the most aspirational consumer goods company in India is really a matter of great privilege and honor. So I feel very, very honored about that. I think as far as the company is concerned, I've been now meeting consumers, customers. I've been around the category teams. I've spoken to functions. I've been to one factory or two. So I have a pretty good sense of the business. And I must say, having come back, I feel very, very proud of what's happened. And the business is in a great shape. It's a great business. Very, very strong positions when it comes to market leadership positions of our brands. I see very strong, to your point of process, very, very rigorous processes. Our talent, depth, and quality is absolutely first class. We have also done an amazing amount of work on community. So I think we're living our vision and purpose of what's good for India is good for Hindustan Unilever. So I feel the impact. I see the programs, and many of them, they are flagship programs. They're making a big difference to the communities. And above all, I think our focus on our strategy is also, I feel, very, very consistent, very disciplined. So if you look at the 2 or 3 fundamentals of driving our portfolio through market development, premiumizing it, driving our brands through purpose and innovation, winning in channels of the future like e-commerce and eB2B, and essentially building distinctive capabilities like winning in many Indias, our Symphony cost program, and our talent. I think I'm very excited with all of that, which I inherit. And my intention now going forward is to take this to the next level. And the market in India, as I mentioned, is changing constantly. So our strategy will evolve, building from our strengths that I've just mentioned. And we will, of course, account for the changes. So whether it's deepening our premiumization effort, or getting further in our Reimagine HUL digitization program, or in fact bringing sustainability even further into the heart of the business while maintaining our core brands, our reach, our distribution strength, those moats. That's really how I see the business going forward. And I think we'll have more opportunities, and as I have more time, we will speak more about this, and there'll be a capital markets day towards the end of the year as well. So yeah, watch the space. There's a lot going on here and lots more exciting things to come ahead.
Is there anything personal which is of specific interest to you? Any category, any area, any form, function in Hindustan Unilever that, or from your experience at Unilever, that you would like to bring to Hindustan Unilever?
So I was here 15 years, and my first day in Unilever, Hindustan Unilever was in the market, selling.